All right, welcome to part 3 of the Ultimate Guide to Insider Buying Masterclass. Now, in the first video, we covered stock scanning, how we go to Guru Focus, how to find the stock screener, what filters to set, and how to generate a list of 30, 50, maybe even 100 stocks on a good day that have seen recent insider buying to begin doing your work on. In the next video, we walked through how to analyze each one of those. We looked at, how to see if this is a stock that sees frequent insider buying versus infrequent, how to look at the individual insiders and say, is this somebody I want to follow? Are they new to the company? Have they been there a while? Do they buy a lot? Do they buy a little? What's their track record look like, etc.? And kind of dug into the top layer of how to run through these fairly quickly, and hopefully you're beginning to see how to whittle a list of 40 or 50 down to maybe 4 or 5. In this video, I want to go a little bit deeper, and I'm going to show you a couple of things that I've found just in my years of experience that helped me a lot. One, I'm going to show you the top insider buy signals, so which things I put the most weight in, and obviously I want to see as many of these as possible. I'm going to show you which insiders I like to see buying the most and which ones carry a little more weight. I'm going to also go over some pitfalls that are going to trip you up when you're beginning. And so there's a lot of, I shouldn't say a lot of, there's a handful of false signals that to the untrained eye may look like good times to buy, but really it's not. I'm going to show you what those are and how to look out for them. And then I'm going to walk you through the actual Form 4. I'll show you how to access that and how to read it so you really know this inside and out. So let's go ahead and begin with my top buy signals. So really 3 main big ones. The first is a cluster buy. Okay, we've looked at a lot of these. The ones we liked in the previous video were ones we saw multiple insiders buying. If one insider's buying, that's good. 2 is better. 3, 4 plus is really what I'm after. So the more insiders that are buying, the better. If you want to find the top opportunities, I'd stick to those. You're seeing maybe 3 or more insiders buying the stock, or 3 or more insider purchases inside of the last 1 to 2 months. Because in general, if the news is really, really good, a couple of people are going to get in on it. It's not just going to be one guy or one woman. So the more insiders that are buying, it's just a greater chance that the news is strong for that company. The odds that all these people are buying at a terrible time is much, much lower than that one person made a poorly timed buy. The next buy signal is first-time buyers. We looked at a couple in the last video. Some of those that we saw, and I showed you that these are kind of good faith buys where, maybe they joined that were appointed to their position in July and they're buying in September. That's somebody who's only been there a couple of months. But if I've got an employee, either a director or an employee who's been there 2, 3, 4, 5 plus years, they've never bought before yet suddenly are, that sends a strong signal. What do they know that they didn't know before? Why is today different? Why are they suddenly buying a stock? And again, there's not any great secret database that holds all these people's employment information, but for large publicly traded companies, they issue press releases when they appoint a new CEO, when they hire a new CFO, and somebody comes to the board of directors. So if you just Google the person's name with the company name, spend 20 seconds on the first page of Google, you're likely to find the article that announces their appointment of their position, so you've got an idea of how long they've been there. Sometimes it's easier than that. Sometimes you go to their track record here on Guru Focus, you click on them, see, okay, they had an insider buying the stock in 2018, and they had one today in 2022. Well, that tells you, hey, they haven't done anything in at least 4 or 5 years. The other thing I like to see as far as, insider buying signals, we got cluster buys, we got first-time purchases, are when they're buying when a stock is at its highs. Okay, essentially, I break down all insider trades into 2 groups. One is basically value trades. So these guys have to comply with something known as the short swing rules. So when they buy their company's stock, they must hold it for a minimum of 6 months. If they sell before that, it's 183 days. They sell before 183 days, the government takes their profits. So they put $100,000 in that stock, it goes up 500%. They sell it after 5.5 months, the government takes all those profits. So they're going to hold for at least 6 months. Oftentimes they hold much longer. I mean, these people, some people be CEOs or high, the C-level executives can be at a company for 10, 20 plus years. So they tend to have a longer term time horizon. They may buy in 2020 when things are very low with the anticipation to hold it 5, 6, 10 years till retirement or till a kid goes to college or something like that. So they are more prone to buy when the stock is down and when it's cheap, even if they have no expectation the stock's going to be much higher in a week or a month or 2 months. So when they're just buying, the stock is very cheap, it's trading a low multiple, that's going to be kind of a traditional value buy. The other time they buy is really the exciting ones. These are the ones I'm looking for, is when they're buying in anticipation of good news. Either earnings are going to be better than expected, maybe they have a drug approval that nobody realizes, maybe a big lawsuit's about to be settled, maybe they're about to get bought out, maybe they've got an exciting new product or new service that's taking the market by storm. Whatever it is, they know the company is doing better than Wall Street analysts and investors are giving it credit for, and they're buying that stock with a pretty good assumption that price will be much higher in the coming months or quarter. Those tend to happen, and it can happen at the top or the bottom, but when the stock is trading at its highs, we know they're not buying for the first reason. We know they're not buying just because the stock is cheap relative to price and earnings and where it's been. If the stock is within 5, 10, 15% of multi-year highs and they're buying the stock, the odds are much better that that stock is likely to return really good news because they think, hey, even though our stock is near all-time highs, we still think it's worth a heck of a lot more. So if I've got cluster buying, if I've got first-time buyers, if I've got the stock trading near highs, and then I just tend to favor insiders with good track records. We showed in the last video how to click on the insider's name. You see their past trades. Some have only had 1 or 2. Some insiders may have made 10, 15, 20 insider trades in the last 10, 15 years. And I'm simply looking at how those stocks have done. There'll be a percentage column on the far right side showing how much that stock is up or down from when they bought it. And if everything they've bought in the last 5 years is up 60, 80, 100, 300%, that's somebody who's got a pretty good track record. And if you want, you can look at those individual trades, pull up a stock chart, just draw little dots on the charts. Okay, he bought here, he sold here. Is he buying lows and selling highs, or is he buying highs and selling lows? If he's doing the latter, it's not somebody I want to follow. If he's got a pretty good history, he or she has a pretty good history of buying near the low or buying before the stock makes a big advance higher, something I'm going to put a little more weight into. So that's the big 4. Cluster buying, first-time buyers, perfect track record insiders, or at least good track record insiders, and then when they're buying near the highs. Okay, that's the 4 big ones. And the more of those you get, the better. I'll take 2 or 3. So if I've got 4 insiders buying and the stock's near its highs, that's usually enough for me. But if I've got 3 or 4 insiders buying, they also have great track records, the stock's near its highs, and they're also one guy's in there buying for the first time ever, a first-time buyer, that's just that much stronger. So like any other strategy or approach to investing, you're simply trying to stack the odds in your favor, or at least stack the bad odds away from you. So if you've got a stock near its highs and insiders are buying it anyway, it's a pretty good sign. If 4 or 5 people at the company are buying versus 1, the odds are that much better. If they've proven they're pretty good at timing these trades, that's that much better. So all the things you can stack in your favor, the better. And it's not just a hard-ruled system. It's not A plus B equals C. There is a bit of an art to this, and you are going to have to kind of get a feel for which ones you have the greatest conviction in. And so sometimes there'll be situations where you're like, man, I've got 8 or 9 stocks. I love all of them. These all look fantastic. And then I've had times where I'm like, maybe this one or this one here. Other than that, nothing's really standing out to me. If you've got money to invest, though, sometimes you're kind of picking the best of a bad batch, or you're trying to limit only a handful when you love them all. So that's going to be really up to you and how much money you want to deploy to each, and how much capital you have, and how diversified you want to be. But just know that the more of those positive things you can stack in your favor, the better. Now, as far as which insiders to track, you're going to see all the usual stuff: the CEO, the CFO, directors. Anytime you see director, that just means they're a board member, right? The board of directors. So if you're a company director, that means you're on the board. And then you've got, vice presidents. For an energy company, there could be a VP of gas gathering. There could be a VP of Eastern European operations. You could have a chief operations officer, et cetera, et cetera, et cetera. I like all of those. To be honest with you, CEO buys mean the least to me. And most people think the opposite, like, well, the CEO, he knows best. I should do what he's doing. I just haven't found that to be the case. And again, I've been doing this 7, 8 years. To me, the CEO is far more prone to buy the stock to simply as a sign of faith in the company, so that the street sees, hey, look, the CEO's buying, he's eating his own cooking, he believes in the company. It's not always that way, but I see a lot more out with CEO than anyone else. If you're a company like, look, we need to make a stand to the street that we believe in this company, that that we think things are going up, that we believe our prospects are good. It's the CEO who's going to sit out there and do that. It's not the marketing director. It's not the vice president of shipping operations. Okay, those guys are generally acting for their own interests. Also, 10% owners. I'm gonna put them kind of in the camp with CEOs as. I like to see it, but I'd prefer to see a CFO, a vice president, a chief marketing officer, something to that effect. Because a 10% owner, usually someone who owns 10% or more of a company stock has a seat on the board of directors, kind of giving them equal access to that. Not always. Sometimes they don't want a seat on the board, or they can't get a seat on the board. But always, the top brass C-level executives know what's going on. Usually a 10% owner does, but not always. So unless you really want to go full-on murder, she wrote, and dig into this person and what they do and call his secretary and find out how much time he spends at the company and really do a deep dive, I would put less weight on the 10% owner and more on the vice presidents and the C-suite guys. One other person I really like seeing is the General Counsel. If I see a buy from the General Counsel, even if he's the only person buying, I'm usually going to take that trade. General Counsel is the company's attorney. And if you know any attorneys, no offense if you are one, they tend to be fairly boring people and fairly risk-averse people. And my brother-in-law is an attorney. I love him. My favorite people on the planet. But you attorneys know it's true, okay? You guys, you're not just, they generally have no appetite for risk. Appearances mean a lot to them. That's why they have 1,000 plaques and degrees and accords on the wall in their office. It's all about the appearance. And as the General Counsel of a publicly traded company, appearance in terms of ethics is very important to them. And the last thing they want is some sort of a black mark on their record as an insider trader. Funny story, the General Counsel at Apple was the only insider in years I've seen have charges pressed against him for insider trading. He was trading off those earnings because there was a lot of money for him to make. And so that's just sort of a side note. But I've found the General Counsel, generally, if they're willing to ignore the potential ethics violations there, and not to say there are the ethics violations when they do it, but just the perception of that as a possibility. They're willing to ignore that. General Counsel also don't make, usually, I don't think, near as much money as a CEO or a CFO or someone like that. So when they're disregarding all of that, and we know they're kind of a risk-averse person, and they try to keep everything above the board, and even they can't resist the temptation to buy some stock in that company, it's usually a pretty good sign. So those are my favorites. If I had to list them in order, it's probably the CFO, the vice presidents, VP roles, the chief this, chief that, chief operations officer, chief whatever, that whole crowd. Then it would be probably the CEO. Then below that, it would be like 10% owners, which includes institutions. And then obviously, as we saw in previous examples, if you look at one of them and it's the BlackRock mid-cap growth fund or something like that, clearly I'm just ignoring that altogether. They're not acting on information. They're managing $20 billion that's just supposed to track a certain subsect of the market. They're just rebalancing to keep in alignment and hold stock to meet their metrics. So that's nothing I'm going to follow into. So those are the best ones I want to follow. All right, so that covers the 4 best insider buying signals. Again, you want as many of those as I can. It covers the insiders I like the best. Again, none of them are bad. It's not as if, this guy's buying, get away. But there are some I like more than others. Finally, I want to cover some false signals or pitfalls you can run into. And I want to show you some live examples here. So let's go back to our webpage, into our results. 3 main things I want to cover. The first is fund activity. And we already looked at this, so we'll go back to the same example here. This is Geldwin Holding Company, JELD. And when we see the activity here, we look at, oh, look, big cluster of insider buying. But then we see, oh, it's Turtle Creek Asset Management. They own millions, hundreds of millions of dollars worth of stock. They're adding very little weight to their position in terms of percentage. And it's just a big, giant, multi-billion-dollar asset management firm, right? So this is fund activity. Is it technically an insider? Yes. Am I going to weight it as such? I'm not. I'm just going to ignore these. If the bulk of these trades are a fund, whether it's BlackRock or it's a Fidelity Magellan fund or it's just Turtle Creek or whatever, that's something I'm going to discount a little bit. These guys aren't playing that dirty. Maybe a hedge fund or something, but these big mutual funds, and especially the exchange-traded funds, the ETFs, they're just owning enough stock in a basket of companies to meet their objective. All right, they're not like trying to beat the S&P by 20%. It's generally like a mid-cap healthcare fund. Their only job is to own an equal weighting of all the mid-cap healthcare stocks. If mid-cap healthcare goes up, they go up. If mid-cap healthcare goes down, they go down. They don't care. They don't get a percentage of their profits. They just get fees for the amount of money they're managing, and they're just trying to keep a balanced portfolio. It's no different than any other ETF or boring old mutual fund that owns 1,000 stocks. So I don't put any weight in those. I believe fund activity is definitely a false signal and something you want to ignore. Next would be those that just have poor track records. I found this one a few minutes ago. This is Elanco Animal Health. It came up on our screen, ticker symbol ELAN. It came up on our scan. Now, immediately we see probably not one we're going to take just because insiders buy the stock every couple of months in a fairly routine manner. Nothing setting off any alarm windows as opportune buying. But I did notice this. I started looking at these insiders. Here's a director, David Hoover, bought 20,000 shares at a cost of $300,000. And remember, everything is very clickable on this website. So if we click their name, we can look at their track record, their history. Now, this is one I talked about previously, if you remember, how don't be surprised if you see an insider who's an insider for multiple different companies, or at least has been. Here's one here. He's got Ball Corp, Eli Lilly, Edgewell Personal Care. And so he's likely on the board of directors of multiple of these companies, or else he served as a chief executive or some C-suite level person at a couple of these companies over the last several years. But what I wanted to focus on here is his track record. Take a look at these buys here. So this is all the trades he's made for the last several years. Goes back to 2018. And over here on the right side, this is the price change since the insider bought. So it's where the stock is up or down from when he bought it. And you see here's trades in EPC are up 20, 30%-ish over the last 3 years, which is just not great anyway. But every time he's bought ELAN, he's lost money on it. He's been buying this thing back here in 2019, 2020, 21, and he's down 40, 50, almost 60% on a lot of these buys. Now, it doesn't necessarily mean this guy's trying to lose money, but it shows me that he does not have a great track record of timing his buys. Maybe he's not trying to. Maybe he just buys every so many months and a couple of times. Who knows why he does what he does? Maybe he's got an inheritance from a great-great-grandmother that comes in sporadically, and when he gets it, he puts it in the stock. There's really no telling. All I know is he's not shown me that he's someone I want to follow. If this guy ran a trade alert service and this was his track record, no one would buy it. So this is a poor track record insider. And so sometimes you'll come in, you'll find a stock. It's like, oh, man, yeah, 2, 3, 4 insiders are buying. You go in, all their track records look like this. It's like, almost had me, guys, but I'm not following you because they're just not very good or their track records are terrible. And it's do what you want. I don't follow people with poor track records. I know we can't predict the future, but analyzing the past is our best chance to do so. In their past says they lose money. All right, so that's number 2. 1 is fund activity. You want to ignore that. 2 is poor track record. The third is simply the size of those trades. I don't really have a good example with this one. Let me look at, was there any in when? Most of these are funds. Let me look at some of the older ones. No, I'm scrolling very quickly. Sorry about that. Just trying to find something. Here's some kind of smaller. These are cells. Doesn't really matter. But anyway, this column over here, the third from the right, it says cost. That's the total number of dollars they put in this in thousands. That's 18,000. That's 273,000. That's 2.2 million. I like to look at the size of the trade. Sometimes you say, oh, man, this company's had 7 insider buys. They're all piling in. They just bought. Let me check. And it's like $3,000, $8,000, $9,000. And look, I'm not trying to poor shame anybody, but if you're a C-level insider for a publicly traded company, you make at least 6 figures a year. All right, so you putting $3,000, $4,000 in the stock just doesn't do it for me. I believe when you see those, and it's not on your screen right now, but just when if that number were like a 3 or an 11 or something, when you see that, it's often 401k contributions. So in their compensation structure, they'll often get either a discount on company stock or a certain match on the company stock. It's sort of like, yeah, sure, once a quarter, take 8% of my salary and put it into the company stock, because they're going to match it. They're going to give it to them at a 50% discount or something like that. So you'll often see them buy. That's generally the smaller amounts, $5,000, $10,000, $15,000. It's like a 401k buy. So it's more automated. It's not opportunistic. Even if it was them manually placing a trade, somebody going in for $10,000 or $15,000, it doesn't show me any conviction. I'm sorry, but if you knew really good things were coming for that company, you're a successful person, likely an MBA grad with a 7-figure net worth, you're putting real money in. You're going to put $80,000, $100,000, $200,000, $500,000 in that stock, not $10,000 or $12,000. So be cognizant of the size of those trades. And then finally, option exercises. Take a look at this. This is Starbucks. Rule of thumb here, avoid the big mega cap companies, okay? The ones that are $100 billion firm, your Lowe's, your Starbucks, your Coca-Cola, your Amazon. Very, very rare that insiders are going to pile in before good news. They know they got a lot of eyeballs on them. 98% of the trades you take following this are going to be small and mid-cap stocks you likely never heard of until you ran this scam. But Starbucks is going to show us what this looks like. What you're looking for is something like this here. Let me show you this, this trade. Now, for some reason, it's not showing up right, but you'll often see it show up like as a buy, and this one shows up as a sell. Sometimes it'll show up as a buy. This is the form forward. We're going to dive into this here in just a moment, but this is the actual form file with the Securities and Exchange Commission. Okay, it gives the name, the address, the position, etc. But here's the trade details down in here, and I want you to look at the two lines of this trade. All right, it's common stock, both on the same date. This code M stands for the exercise of a derivative security, i.e. an option. They're exercising an option, but you don't even need to know those codes. Code is M is exercise. Code S, I believe, is open market sale. But just look here, the 4,000 and the AD and the prices, okay? A stands for acquired or bought. D stands for disposed or sold. Acquired, disposed, bought, sold, okay? So on the same day, on September 15, 2022, this insider, Sabrina, acquired or bought 4,000 shares at roughly $25 a piece. The same day, they sold 4,000 at $93 a piece. Now, I've seen volatile stocks before, but this is Starbucks. I've never seen Starbucks go from $25 to $93 in the same day. So how is this possible? Well, they're exercising an option. The reason they could acquire stock at $24.87 is they had call options or warrants issued by the company that allow them to buy up to 4,020 shares of stock at a price of $24.87 up to, is probably expired the end of September. Well, here it is. It's in the fine print. The option representing the right to purchase 4,000 shares became exercisable in 2 increments. November 14 in 2 increments, November 15 and November 16. Okay, so they've been exercisable for several years, but they're now exercising those options. So when you exercise an option, a call option is the right to call away the stock at a given price. So the company gave him a contract, says you have the right to buy 4,000 shares at $24.87, probably for like anywhere in this 10-year period. So at the time, the stock was probably like $15. Well, I'm not going to pay $24 for it. If I can go to the market and pay $14 for it. But years later, as the price rises, well, now it's worth $90, $100 a share. He can still buy it for $25. That's what gives it the value. So they're going to exercise the option. They're going to exercise their right to buy those shares at $24.87, and then they are going to immediately sell them in the market to collect the cash, in this case for $93. So 4,000 shares times a profit of, what is that, 60, 70 bucks a piece is what? $280,000 in profit. They just cashed out with this. So Sabrina just made $250,000 cashing out her stock options. Okay. But sometimes they'll show up in the screener, and especially if you're on sites like Open Insider or something that just dumps this information, it'll show up as a buy because she did buy stock. She did buy 4,000 shares, but she's exercising the option, and she also immediately sold them. Okay, so you want to be cognizant of those. And I know there's a lot of information. Again, I've been doing this for a while. There's a reason I run a service called the Insider Effect. This is not stuff that you can just, it's not A plus B equals C. It's not red line, green line. If this is all over your head and you'd rather, you want to learn more about what we do and let us do the research and feed you these trades every month, call us and we can tell you about the Insider Effect service. You'd rather go that route. But I do want you to, if this is something you want to do, I fully want you to pursue this, and I want to try to make you an expert in this, and this is a big part of it, is understanding when you're getting an option exercise and not a real buy. Okay, so just be cognizant of that. Often they'll show up in here like the same name. It'll be a buy and sell at the same time. But you just want to make a habit of looking at each of those. Okay, so that's the big false signals. Fund activity, which is not real insider buying. Poor track records, those that just proven to you over a period of several years. They're not good at timing when to buy the stock. They're not great long-term investors, and they're not somebody you want to follow. And then third, those option exercises. Is it a real buy, or is it just cashing out of a stock option? Or is it a CEO who just got put there a month ago and he's making a good faith buy and showing he believes in the company, right? A CEO got appointed 60 days ago who just bought $500,000 worth of stock. I don't care. It doesn't, I'm not convinced. You're not tricking me. All right, remember, a CEO's entire job, their entire job is to increase the value of the stock, period, hard stop. You might think, no, they're in charge of making a good product or a good service and maintaining a good culture. BS. They are paid, hired, and fired by the shareholders. Their job is to protect and increase shareholder value. I don't care how warm and fuzzy they make you feel inside. I don't care how inclusive their office is. I don't care what wonderful environment they create there. If the stock price falls 80% in the 3 years since they took over, guess what the shareholders are going to do? They're going to vote him out and hire someone new. That's why the bulk of their compensation often comes in terms of stock and stock options. Elon Musk is the richest person on earth, with the possible caveat of Putin being richer. But as far as with records we know about, he's the richest person in the world because of his stake in Tesla. Guess what his salary is at Tesla? Zero. His entire salary was dictated on bonuses. They said, all right, if Tesla price is above this, you get this many million shares. If it's above this, you get a bonus of this many million shares. If above this, you get this. So it's all options and stock. So, the other year, 2 years ago, when Tesla stock went up 1,000%, hit these metrics the board of directors could have never fathomed. He walked out and made $500 million that year in Tesla stock. His salary was zero. If Tesla stock does not perform, Elon doesn't make any money. And a lot of these CEOs are paid similarly. Maybe they have a $300,000 or a $500,000 salary, but if they want a $10, $20, $30 million year, they got to increase the value of that stock. So make no mistake about it. When these CEOs go on Kramer, they go on TV, they're touting their company, pay them no mind. They're the first person that's going to lie to you. Maybe what they're telling you is true, but you have no way of trusting it. It is literally their job to shill and prop up that stock So take that with a grain of salt. Okay, I feel like I'm beating up on CEOs. I'm not. I'm just trying to make you understand. A lot of people give a lot of reverence to the CEO, but you have to understand their objectives. You got to understand. You want your interests to be aligned. That's the whole idea behind this insider trading approach. We know their interests are the same as ours. We know the chief marketing officer and the CFO and the executive vice president of public affairs. There's only one reason they're taking $300,000 of their family savings account and buying the stocks because they think it's going higher. They're being greedy for their own gain, which is fine. I just want to piggyback that greed. But I know they're buying for one specific reason. It's because they truly, in their heart and with their gut, believe the stock is worth a lot more. So the CEO is the only person that may want that, but may not fully believe it because their compensation depends on manipulating that stock price, okay? All right, so let's dig into a Form 4. I'm just going to walk you through this really quickly. Now, you can access these Form 4s, any one of them, right from this site. If you want to go to the SEC's website, let me just show you what that looks like, sec.gov. It's here. If you go to filings and hover over that, you'll see the Edgar database, so you can go search and access in here. You can go through like a company name or CIK number, and like, for instance, just SBUX, Starbucks, and it's going to give you all their company filings in here. Now, this is everything. This is 8Ks, their quarterly reports, the 10Qs. The 10Qs are the quarterly reports. There's 8Ks, there's 10Ks with the annual report. It's whatever this PX notice of exemption solicitation. I mean, every single thing they have to file in there. Included in that is these Form 4s. And so you see up here at the top left is exclude insider transactions. Isn't that funny how the SEC's website by default does not show you these? I'm not going to say it's a conspiracy theory, but it's at least not promoting this type of approach. So we are going to include insider transactions. And here they are, the Form 4. Form 3 is an initial statement of beneficial ownership. Just focus on those Form 4s, and that's where they all are. And you can click on it, and it'll take you to this link. But again, as I said, the system is very archaic. If you were trying to do this research strictly through the SEC's website, you have to go one ticker at a time through all 6,000 of them, find these. Even when you find one, you don't know how many times this insider buys, you don't know their track record's like, you don't know any of that information. So as I always say in the webinar, you really need a somewhat sophisticated system that's gathering all this data, and Guru Focus is probably the best one out there. But you can also, the easy way to get to these is when you're doing your scan on this site, it's got the insider's name, position, date, buy or sell, shares, et cetera, all the way to the right, it gives you share ownership details. And this is generally, I want to see direct ownership. There's two things. There's direct and indirect. Direct just means they directly bought it in their name. Indirect can be a number of things. You'll see some here like a trust, a revocable trust. It could be in their 401k. You'll often see this, trust in the name of their wife or their children, or it's even like when you see these big funds or a hedge fund buy, their name's on it, but it's an indirect buy for the fund. But nonetheless, the details here, if you click on that, will take you to the actual Form 4, okay? Now let's just walk through what you're seeing here. Now from the top is a Form 4 from the United States Securities and Exchange Commission, or the SEC. It's the official name of the form is a Statement of Changes in Beneficial Ownership. Just means they bought or sold stock. Top left, it's got the person's name. It's got their address, which, by the way, these are generally not their home address. It's going to be either the company address or their attorney's address. The name and ticker symbol of the company right there in box 2. The date of the transaction or the trade there in box 3. In box 5 here in the top right, it's going to give their position. If it's an officer, below it'll say what the exact title is. If it's a 10% owner, it's 10% owner. If it's got a little letter next to it, like see here, the 20,000 at the number 1 in parentheses, it'll be green. That's just going to be a subscript, and you go down to the bottom and see what that position is. And then it shows, whether it's an individual or joint filing. Mostly it's going to be one reporting person. Okay. And then below that in table 1, it's got a summary of the stock trades. This is non-derivative, meaning not options, not warrants, just the stock. And so here we see September 9th, the code P is for purchase. The amount or the number of shares is 20,000. Now there is a little 1 in subscript there. So you see down there in the explanation, it reflects the price of 20,000 shares of common stock purchased in multiple transactions on September 9th, with purchase prices ranging from $15.10 to $15.26. So they're not fighting it. They're not willing to take any chances of misreporting, getting any trouble. They want their money. So it's going to be an average price here. The big one here, AD, is just going to tell you if they bought or sold. So did they A, bought, i.e. acquire, or D, dispose or sell? This is the average price they paid, and this is the number of shares they now own after this purchase. So some basic math, you can see, okay, well, I guess they owned 125,000 in here before they made this buy. Now, you'll notice there's 3 lines because it may be direct ownership or it could be indirect, as I said, with these trusts. So here they own the stock in 3 instruments. And don't worry about this part. It doesn't matter. We're only focused on where they just bought, but it just summarizes where they own the stocks. They've got 39,000 shares in direct ownership. So that means David Hoover has an account somewhere at Fidelity or Schwab with 39,000 shares of stock in his name. He also has the Susan A. Hoover Revocable Trust. So it's likely his wife has a trust, and that owns 15,000 shares of these. And then he himself has a revocable trust with 145,000 shares. So why is he doing a trust? Well, it's tax purposes. It's all kinds of fancy rich guy stuff. It really doesn't matter. He bought it. It's his. Doesn't matter if he did it in a trust or in his personal account or in his wife's name or in his 401k. He's buying because he thinks it's going higher. All right. Now, if there were any option trades, those would be down here in Table 2 for derivatives, securities acquired, disposed, and beneficially owned. It's going to be a summary of any trades they made with warrants, puts, or calls. And then below, as we read earlier, is an explanation of any responses. So if there was any super subscripts here, it may say, well, 10% owner, and then it's going to go, well, they're, as of this transaction, they're officially a 10% owner, et cetera. But anything they need to clarify will be listed down in here. And then, as you saw here, up here at the top, their position as the director, they've clarified that down here in the remarks, is chairman of the Elanco Board of Directors. Okay? And then, of course, this is always signed by their attorney, as attorney, in fact, for R. David Hoover, dated, and that's it. And that's what a Form 4 looks like. But as I said before, if you didn't have software that scanned all these and put them together in a usable format, that couldn't aggregate this data so you can look at their trading history, so you can look at a summary of insider trades with the whole company, a summary of this person's insider transactions, their track record, the average size they buy, and all the things in between, these pieces of paper would be just about worthless because you'd have no way of knowing when you looked at this whether David Hoover bought 20,000 shares last week too, whether he bought 50,000 shares the month before, and now he's scaling down. You wouldn't know if he just joined the company. You wouldn't know if he buys a lot. You wouldn't know if he's got a terrible track record. You wouldn't know if anyone else at the company's buying with him. None of that is revealed in the Form 4, which is why this software is so utterly important and why you really need it to get the full picture for the insider trades. But that's about it. Now, you're likely going to want to watch this a couple of times because I've thrown a lot of information at you. We've covered the sites to use. We've covered how to scan for these. We've covered the scan criteria to generate a list, how to look at the charts of insider buying as far as the number of trades and the volume to quickly identify those showing opportunistic buying versus those that get bought all the time. We looked at how to differentiate between insiders with good track records and those with bad. We've looked at how to see if a lot of people are buying. Is it a cluster buy or very few buying? Is this person buying a lot based on what they normally buy in their salary, or are they buying very little and it's something we want to ignore? We looked at our favorite buying signals, things like cluster buys and first-time purchases and stocks trading at highs. We looked at the insiders we prefer to follow, the vice presidents and C-level executives and the General Counsel. We talked about why the CEO buy is not always to be trusted, why you want to kind of avoid fund activity and big ETFs and mutual funds. We looked at other false signals like option exercises, and insiders just have poor track records that you may not want to follow going forward. And then we've kind of slowly walked through these and kind of given you a top-down approach of how to quickly begin running through these one at a time. And just kind of, again, everything's very clickable on this website. Go one at a time through the stocks. Is it opportunistic buying? Yes or no? No. Move on. If it is, keep going. Okay. Is it several insiders buying? If so, let's take a look. Do they buy a lot? Are they buying big for their size, or do they have good track records? Have they been at the company for a while? All those things you want to look at. And then we're going to go into the Form 4 and just make sure this is not an option exercise or not something kooky about it. They're not buying for a hedge fund or something like that. And then once you've done that, just keep a scratch piece of paper next to you. Write down the ones you like. And the first couple of times you do this might take you a couple of hours. You may want to re-reference these videos and go back, but you should, after a couple of months, be able to once a week run this scan. Half the names you see, you'll have already checked the week before, and you can breeze right over. You'll end up with probably 2, 3, 4, 5 stocks that really catch your attention. You jot down a piece of note paper. And then after that, or the next day or something, go through those one at a time. And if a couple look very appealing, you see multiple insiders, they're good-sized buys. They've got good track records. They don't buy a lot. You go to the chart looks, if it's at high, it's going to be another positive for you. But if it's at least stopped falling, maybe they're trying to time the low or whatever technical aspect you're looking at through the chart. And the ones you like, you might decide to invest in and take a little position in that stock. We've got other videos that were included in this covering risk management, where to place stops, how I like to sell into strength on a lot of these. If you have not watched those, I would encourage you to do that. I've got the one I'd probably recommend the most is the Risk Management 101 video. I walk through some successful trades we've done using this approach and how we like to take profits on the way up, selling into these parabolic extended moves, raising our stop loss along the way. And what that allows us to do is constantly de-risk the trade, put more profit in our pocket, and protect our gains as it rises by increasing our stop loss behind support levels and selling pieces of that position on the way up in order to kind of maximize our profit. So definitely, if you have not watched that video after this, it's going to be, I think it's like 20 or 30 minutes long, but it'll be a huge lesson for you in sort of my approach anyway. You may not like it, but it's what I've seen the most success with is in terms of where to take profits and how to use stop losses and how to risk 10, 15, maybe 18% of the stock, quickly de-risk that trade, take profits up, and constantly lock those in as the stock goes higher. So I definitely recommend watching that. But look, the approach is simple. The idea is common sense. We're following people who know that company inside and out. We're following the CFO and the vice president and the chief marketing officer and the chairman of the board and people who have intimate, non-public information about that company that gives them an enormous edge in the markets. When several of these people are piling into the stock with their own money at an opportune time or for the first time in several years, oftentimes that's a really great tip to buy a stock. And I've had some really nice wins from this. Is every stock going to go straight up? No, you're going to have losses. Nothing works 100% of the time. Hence the stop losses and hence the protection and the risk management. But if you do this for a while, I can almost guarantee you're going to see some big wins. I've had stocks that have tripled in weeks. I've recommended stocks that are up over 1,700% in 2.5 years, and we still own them. I've issued sell recommendations for option gains of 1,090%. I can't even count how many 100, 200, 300, 400% option gains we've made, because when you get in a good market and these stocks are popping and you're buying a stock option near the money 3-6 months out, and that stock goes up 15, 20, 30%, that option is going to be up 100, 200, 300%, and we just closed out a lot of those wins. If after watching this, you think, what did I get myself into? This is too much. I have no interest in doing this. Look, I understand. And so we don't want to take your money if it's something you're not interested in. However, if you still believe in the approach, I want you to at least consider my Insider Effect Trade Alert service. It's one I've been running since 2017. We've been profitable every single year, including 2022. As I'm making this, we're currently up on the year. The entire portfolio returned 292% in 2020, and that's just the stocks. It's not the options. We made something like 58 or 59% the year before that. I mean, it works. Does every trade work? No. Do we have losses? Sure. But we've also seen lots and lots of really big winners. And so if this is something you want to pursue, maybe you bit off more than you could chew, or at least it seems like you don't have interest in pursuing this further, call Traders Agency. Let us tell you about the Insider Effect service. Tell them I said to make them a good deal on this because you're an undercover trader member. You decided you'd rather go that route, and we will hook you up with a special price on that to become a member of the Insider Effect, because I don't want you to miss out on this stuff. But as you can see, it is a lot of work. We've got full-time analysts here. We have software costs. We have it takes a lot of time, takes a lot of experience, takes a lot of resources to run a service this caliber, and it just takes a lot of time. I mean, even when I find a stock, go through all these hours and spend the time and find a good recommendation, it takes me several hours to write the thing up because I'm doing a full multi-page write-up showing everything, which insiders are buying, what their track records look like, what's going on with the chart, what the fundamentals look like, where to buy the stock, what option to take. We really lay it out there on a silver platter for members, to where at the end they just have a highlighted line that goes, the recommendation, buy this stock right here, place a stop here, further trade the option, buy this option. And then when it's time to sell, we send out another alert. So we track all that for them. It is a lot of work to do, and I had no interest in starting that service 5 years ago, and I did. I did it because nothing existed that did it. I looked everywhere for someone else doing this kind of research and couldn't find it. And it was kind of that axiom, if you want something done right, you got to do it yourself. And I did. And so I began offering it to the public, and we just had a lot of success with it. So love to have you a member on there. But I'm not trying to shill the course. Or the service, excuse me. This course was built, and I built this course with the intention to teach you how to do what I do. I want to empower you with those skills. I'm not holding anything back. I don't have some secrets I'm not sharing with you. But as you've seen, this is a fair amount of work. It's going to take some time. It's going to take some practice. If you're willing to do that, fantastic. You can be successful at this. I promise you can. Dedicate some time to it. Watch this a couple of times. Go through the website. Check what I'm saying. Practice this. Look at some. Study the stocks. And over a period, you will become kind of second nature, and you will be better versed at this. But, some people get excited about it. They come see the course. They think, that's more work than I wanted. And look, I understand. People live busy lives, right? You may have a couple of kids and a full-time job, or you may be retired, just not want to spend that much of your time doing this. And if that's you, that's okay. That's why we have the Insider Effect service there. But trust me, you can do this. Give it a shot. Give it a real honest effort, and you might be surprised at the results. So that concludes the complete guide to Insider Buying Masterclass. I hope you've learned a lot. If you have questions on this, please feel free to reach out to your representative here at Traders Agency. We want to be there for you. If you've got questions, they know this approach fairly well. They should be able to answer a lot of those. If they can't, they will forward your question on to me personally, and I'll answer it myself. But I want you to succeed at this, and I want this to work for you. And so if there's any questions you have over the material or something new you've seen that I may not cover, definitely reach out, shoot us an email, give us a call, and we want to answer that for you. So thank you again for viewing. Be sure to watch the rest of the bonus materials there in the members area, and watch out for your monthly report I'll be sending out each and every month. You should be seeing that in your inbox, as well as my weekly market update video. Thank you.